So, my first question to you, what is your view on bonds in the emerging markets?
Well, emerging market bonds had a fantastic year last year with returns 14 to 18%. But I think this was extraordinary. I think we need it's easier to look backwards than to look forward. And when you look backwards, the average return has been close to 10%. The asset class is now investment grade. It's not an asset class that is as esoteric or as a niche product or illiquid as it used to be in the past. So it's very important that investors also reassess their expectations and feel more comfortable with an asset class that is going to be delivering single digits returns, hopefully on the high side. The main thing that an investor can achieve with the asset class is in terms of diversification, both geographical and numerical. So no matter what, emerging markets make a lot of sense to have in the portfolio from a strategic perspective. Especially when we talk about local debt markets, where we see most of our investors on the institutional side building an allocation from 0, 1, 2% to 7 to 10% of their fixed income exposure into the asset class. So it provides income diversification, but from a total return perspective, we need to get used to lower returns in the future, more in line with the developed world, although in our opinion outperforming.
So, which are the trends of those markets?
Well, the main trend we've seen is the continuous development of local debt. So it's not surprised that we see pension funds and central banks preferring this segment of the asset class when they build the allocation to emerging fixed income, mainly due to its liquidity. So I think this is going to continue. We're going to continue to see a 10 to 15% growth on local debt markets. There is a very good match between demand and supply. So we have this demand for institutional investors buying an asset class that is also becoming increasingly liquid and increasing also its duration. The second trend that we see is demand from insurance companies for corporate debt, as they are looking for a book yield type of strategies. And this is in essence summarize the main trend. Basically, an asset class that before 2008 was dominated by retail investors, and after that gradually the composition has changed to an asset class much more dominated by institutional investors. That's the main trend we see regarding the demand.
Which countries do you trust the most and why?
Trust is a hard concept to implement when investing. We prefer to look in terms of investment themes. So which are the countries where we have very strong investment themes at the moment? Some of the countries we like is, for example, Mexico. We like the implementation of economic reforms there. We like as well Russia, so countries that have become much more credible in the way of managing their inflation expectation, controlling inflation as opposed to growth. And those two countries I think are a very good example of the positive improvement not only in economic side but also in market development, with also markets becoming also easier to trade, easier to invest as well in the local side. So Russia is actually following the Mexico path, which we believe is very constructive with the asset class in general terms.
Which sectors investors should pick?
Well, for us, local debt should be the strategic allocation. So what we're recommending is investors adding to the asset class to have around 70% of their exposure into the strategic long-term allocation, and the rest a mixture of hard currency, sovereign, and corporate. The corporate debt is now having a more stronger momentum. It's $1.1 trillion. Yields are quite high as well. Maybe the only thing that it needs to improve a little bit is the liquidity, but that's going to come over the next years. So for total return, we believe either local debt or a combination of all the strategies, local, corporate, and external debt. For other type of investors, more interested just in yield, we like very much the dollar corporate debt space because there is no FX risk, but the spreads are quite attractive at the moment.
In your view, which are the best opportunities in this period?
Well, if you are very short-term oriented, I think hard currency. From a tactical point of view, I will recommend investors to add to their overweight into emerging market hard currency because spreads have overshot in May and in June. So we think with spreads above 300, 350, there is an attractive value. So the yield has adjusted. Emerging market is not completely decorrelated to the world. If anything, is more integrated. So in the midst of repricing of fixed income, emerging market also repriced. So from a yield perspective, corporate bonds and sovereign bonds have become attractive for the next window of 2 months where the repricing happens, and investors go there to hunt also for good value and opportunities in external debt. If I need to think more strategically, I would recommend the core of the strategy, as I said before, is local debt.
At the end of the day, what would you suggest to investors now?
Well, I would suggest that if you are invested into strategies like local debt or aggregated strategies with local, external, and corporate debt, the investment should be very dynamic. So the world has changed. We are not anymore into the 3 to 5 year fundamental regimes that we could forecast before Lehman Brothers. Economic cycles have become shorter. So it's very important that investments adapt to that reality, and that managers investing in emerging market debt are also flexible in their approach and have full freedom to implement their investment views, because we move from bullish to negative extremely quickly, risk on, risk off, in shorter and shorter cycles. So what I will recommend is that flexibility is very important when selecting a portfolio manager, because these markets required to be very nimble, because visibility ahead of 6 months is now very difficult to find. So it's very important to adjust very quickly to a very challenging environment full of Pandora boxes and surprises that constantly come to our asset class.
Thank you for your time.
Thank you.